Did you know that that pre-approval letter you got from a lender doesn't automatically guarantee that you're going to qualify for a loan? Did you know that you have to keep your credit score, your pay stubs, your cash flow, your bank statements all consistent through closing? It's actually quite easy to accidentally sabotage your ability to qualify for a loan. Today, I'm going to share some pro tips. Some you may have heard and some I guarantee is going to be new information for you. I'm going to inform you to the best of my ability to ensure that you don't accidentally sabotage your ability to qualify. Let's get started. Hey everyone, welcome back to my channel. I'm Erica Monroe. I'm a Bay Area realtor with RE/MAX Gold, and I specialize in Solano County. If you've just started the pre-approval process, or maybe you've just received that letter from a lender, it's so important to continue to keep your credit standing the same through the close of escrow. The credit score is what the lender focuses on. It gives them so much information about how you manage your money. They just want to ensure that you're actually going to follow through with making your mortgage payments each month. A change in your credit score can be a big red flag to a lender and could potentially jeopardize your ability to fully qualify for the loan. So things like opening a new credit card or a new account, even at a big box store, that's going to be a strike against your credit. If you co-sign for a loan, even if you have no intention of making those payments yourself, perhaps your buddy just needs your qualifications to purchase a car, don't do it. The lender is going to have to factor in that debt against your debt to income ratio, therefore changing your credit score, and it may be enough to knock you out of the running to purchase the house. You also want to avoid large purchases. I know how exciting it is to officially be in contract and you start daydreaming about the decor, the furniture, what appliances you plan to buy. Well, make sure you wait until after closing to purchase these items. Again, any major purchase can change your debt to income ratio. It can also change your credit score, and it may jeopardize your ability to actually qualify for the loan. Counting on physical cash, not cash held in a bank, but physical, actual cash, could be the downfall of you no longer qualifying for a home purchase. What do I mean? A lot of buyers receive what's called gift funds, typically from a family member. It's a gift, an amount of money that's agreed upon in advance that the buyer does not have to pay back to the family member. Well, this is amazing and it's so common, but I've actually run into so many scenarios where a buyer's relative doesn't believe in banking institutions. They prefer to keep their hard-earned cash at home or elsewhere, and they have such great intentions of wanting to gift you these funds, but they can't physically bring cash to the closing table. If you are working with physical cash, here are a few potential solutions for you to consider. Again, consult your trusted lender to ensure that this will work for your loan type. If your gifter, likely that family member who's planning to provide a sum of money that'll go towards your down payment or closing costs, is able to slowly start depositing cash into their own account, have them do so. Just keep in mind that any deposit or withdrawal above $10,000 will be reported by the bank to the IRS. So not giving you advice, but just keep that in mind. Once your gifter has successfully deposited the amount of money they plan to gift you, wait until you're actually in contract. Have that gifter wire money directly to escrow. Avoid having them wire it to you, because then the lender is going to have to trace the money leaving the gifter's account, arriving to your bank account, departing your bank account, and arriving to escrow. It's just much cleaner if the gifter can wire their funds or create a cashier's check and send it directly to escrow. If your gifter does not have their own active bank account, or they just don't trust bank institutions and they want to give you the money directly, it may delay your ability to purchase the house, but it won't prevent you from purchasing. If your gifter provides their gift to you in physical cash, you can slowly start making those deposits into your own account. The caveat is those funds have to stay in your account for a minimum of 60 days. At that point, the lender considers those seasoned funds and they'll accept them as your own money. So we no longer have to deal with physical cash and trying to trace where that came from. That may be an applicable solution if your loan type does not allow you to accept gift funds, or maybe if the funds are coming from a non-family member. Again, check with your trusted lender to ensure that this may be a method that helps you qualify for a home loan. Another misconception or situation that may prevent you from qualifying for the loan is aggressively paying off your debt. It sounds like a great idea, right? If you have a large balance on your credit card and you start aggressively using your cash to pay down the balance, you'd assume that that would increase your credit score. Well, if the lender used that cash, those physical funds, to qualify you for the loan, and you've now depleted those funds to pay off your credit, you may no longer qualify for the loan. My trusted go-to lenders always advise my clients to hold off on paying down their debt. It could be that you would qualify with no issue without paying down the debt, and it would be better to have those funds available to go towards your down payment or closing costs. If the lender does deem that it's necessary to pay off some of the debt, they can often help you set that up and you can pay it off at the closing table. If your debt is significant and there's just no way to get you to qualify for a loan without paying it off, then they can help you create some goals and perhaps a payment plan to get you to a pre-approval state faster than you would have otherwise. Making large deposits into your own account that don't fit your typical income pattern will be a red flag for the lender, and they more than likely won't be able to utilize those funds towards purchasing a house. The lender wants to ensure that you actually qualify for the mortgage, that you're going to be able to comfortably make these payments each month and not default. Lastly, avoid changing industries for your profession. I have had clients successfully start new jobs while we're in the process of purchasing a home. Though I don't recommend it, sometimes it's unavoidable. But completely shifting to a new industry may take you out of the running. The lender needs to see a consistent work history. If you stayed in the same industry and you start a new job within that industry, they can trace your work history back 2-3 years without issue. But if you're starting a completely different job in a new industry, there's no guarantee that you're going to thrive. That may be a reason for the lender to pull the approval and decline your loan. So just make sure you plan to the best of your ability, close on that house before you make any major professional moves. Qualifying for a loan is so intricate, and now more than ever, lenders are looking through your file with a fine-tooth comb. So if you ever have questions about should I or shouldn't I, always ask your trusted lender. Make sure that that won't jeopardize your ability to purchase a home. If you're worried about putting it in writing, give them a call. A good lender will tell you truthfully what to avoid. They'll have your best interests at heart, and they'll get you to the closing table. Thanks so much for watching. Please like, comment, subscribe, ding that little bell so you'll be notified when I post my next video.